going to be talking about two indicators, RSI and stochastics. Now, I'm going to qualify this and tell you that I don't use either one of these. Okay. I am a price action trader. I trade from support and resistance. I trade from chart patterns. I trade from candles on a chart. I very rarely use indicators. Now, there's some technicians who use nothing but indicators. But if you keep in mind that an indicator like RSI or all indicators do what? They indicate. We can think of RSI and stochastics as the interpreters of price action. In other words, when you can't make heads or tails out of price action, or you can't understand exactly what it's saying to you, you can use them for interpreters. So imagine you're at the UN and you speak fluent French, but there's a speaker up there who speaks French, but he's from Belgium. He speaks with a much heavier accent using slightly different words. So you put on your headset and you use the interpreter, who is excellent and fluent in French from Belgium as well as French from France, because you don't want to lose the little innuendos, the little aspects. Well, that's what these indicators are. They help clarify and give you defined ideas of what is happening in the markets. Now, RSI has been around since 1978. It was developed by a technical analyst called Wells Wilder. Now, first, let's close our eyes, and if you're old enough, think about 1978. Well, I had started trading about 6 years before that, so I had already been trading by hand. And those days, remember, we didn't have much in the way of computers. Computers were these great big things that took up big rooms and had to be air conditioned, cooled, and you had the MS-DOS green screen, and some even before that did those computer punch cards. We would sit in the pits and draw our charts by hand. There was no computerized generated charts. There was no computerized generated indicators. You would sit there and have to do the calculation yourself and put them on your charts. But in 78, the world was a much slower place. And RSI was primarily developed for the stock market. Now, RSI basically attempts to identify overbought and oversold conditions when trading an instrument. Now, don't run away and say, I don't want this. Because as online trading developed and this field of oscillators, and RSI falls and stochastics both fall into a field that's known as an oscillator. In a second, I can take you over a live chart and I'll show you. But we started to realize as we got online charting and faster computerized charts that these oscillators also were easy to adjust for much smaller time frames and were reliable in smaller time frames, and therefore adaptable to online trading for CFDs, for Forex, and also we were able to elaborate on what they told us instead of just overbought and oversold. Now remember, overbought and oversold are not finite places. Overbought and oversold are indications. They are areas. They are giving you an understanding of the stock is oversold, and so the price has gone up too fast, too high. Overbought means, I'm sorry, the other way. Overbought means been bought too fast and gone up too high. Oversold means it's fallen too far, too fast. But it doesn't mean that an asset that reaches overbought is necessarily going to fall. It can stay overbought for a long time, or it can fall back into out of the overbought zone and stay and continue going up. It just is a momentum gatherer. It's telling you that at that point, that momentum had moved too far, too fast. So let me pop up a live chart and see if I can show this better. Okay, so let's get rid of stochastics right here. We'll bring it back later. And we're going to stick with RSI for a second. Oh, here we go again. For some reason, let's go over to a different chart. For some reason, this chart doesn't want to stand properly. Okay, so on this chart, we have RSI. Let's get rid of stochastics again here. Okay, and we have RSI down here on the bottom. Now, the purple area is just an area. If you notice on the right, first of all, our indicators goes on the bottom of our screen. Okay. And the barrier for RSI goes between 0 and 100. This purple barrier is between the 70 and the 30 range. So anything over 70 is considered overbought. Everything under 30 is considered oversold. Then we have a center line of 50. So lots of rule books say that if an asset goes into the overbought zone, you should sell it or get ready to sell. If it goes into the oversold zone, you should be ready to buy. But it doesn't really work well together that way, because you can see lots of these assets here never reached into the overbought or oversold zone. But look at that, it turned around and flew up, because it's not that simplistic. Now, with RSI, we have things like divergence. We have when the asset is moving one way and the indicator is moving the opposite. So that's divergence. So we have overbought and oversold. And we also have the break of the 50 line. This is when momentum is shifting its direction. And stochastics, as well as RSI, is also the same bounded oscillator. Bounded because no matter how you calculate it, the mathematical calculations will always come out between 0 and 100. Okay, so it's bounded between that range of 0 and 100. With stochastics, the barrier range is 75, 25, but these are easily adjustable. And different assets have different ranges and adjustments to them. Now, I can give you the general rule of thumb, but you might find some assets tend to spend more time over 75, but don't break 80, or more time under 30. So you might want to adjust your settings. So you can adjust the upper band, say to 75, and the lower band to 25. It's not going to change any of the calculations. It's only going to change the way you see it on your chart. So you have to understand that it's not a set of finite rules. The personality of an asset is interpreted or indicated in that oscillator. And by knowing how that particular asset works and what it typically appears to be can help you a great deal. So let's go back to my PowerPoint now. So an oscillator is a technical analysis tool. As we as traders use this to give us an indication of whether an instrument is overbought or oversold. We use these overbought and oversold extremes to see in which direction the price action will have momentum. So RSI and stochastics are momentum indicators. So remember, if you shoot a rocket into the sky and it's traveling up and up and up and it's traveling at a very fast speed, it might show you it's going overbought. What you want to do is see when that rocket's starting to tip over or loses momentum. But that doesn't mean that the sun doesn't happen to come out and a cloud passed by, so that the air heated up and so that asset kept on going up, or that rocket kept on going up farther, or maybe got caught in a wind, whatever you call those wind things up in the sky, and it carried it up higher. It's just like if you drop let go of a helium balloon. Sometimes it goes way, way, way high. Other times it blows sideways. So we can see that the indicator is going over 80, but there's no saying when it goes over 80, besides it's overbought and it's starting to lose momentum, that it couldn't travel up farther and higher, or that it couldn't travel sideways, or it couldn't dip down with the wind chill and then move back up. Now, the calculation for RSI, and you'll never have to do this calculation, it's dropped on your charts automatically, but I think it's always important that before you start to use an indicator and start to use it for interpretation, that you understand what numbers make up that indicator. And the calculation for RSI is relatively easy. RSI is equal to 100 minus 100 divided by 1 plus RS. RS is the average number of days when the instrument closed up or closed down. So to simplify the calculation explanation, RSI is broken down into two basic concepts. You have RSI, average gain, and RS, average loss. The RSI calculation is based on a 14-day period or 14 cycle period, 14 candle period. So if you're looking at a 1 hour chart, it's 14 1-hour candles. If you're looking at a 1 day chart, it's 14 days. So the very first calculation is the average gain and the average loss for the simple 14-day period. So what you do is the first average gain is you go back over those 14 periods, and each candle that it gained, it could be 1 candle, it could be 14, it could be only 3 candles. You add those gains together and divide it by 14. Then you also take the average loss. And if you had 6 candles that went up and had gains, you're going to have 8 candles, and you take how much that loss was. Add it together, divide it by 14. And the second and subsequent calculations are based on the prior average and the current gain or loss. The average gain would be actually going back 13 days plus the previous gain. And the average loss would be going back 13 days plus the current loss. So that gives you the 14 periods. Taking the prior value plus the current value is a smoothing technique, similar to that used in calculating exponential moving average. This also means that the RSI values become more accurate as the calculation period extends. Now, RSI uses a 14-period look back, so it's 13 plus 1. But the more times you've had it on the chart and the longer it is, the more data points you have on that chart. So Wireless formula normalizes RS and turns it into an oscillator that fluctuates between 0 and 100. In fact, the plot of an RS looks exactly the same as the plot for the RSI because it's 100. The formula, remember, was 100 minus 100 divided by 1 plus RS. So RS is basically the same thing as RSI. So the normalization step makes it easier to identify extremes because RSI is range bound. RSI is 0 when the average gain equals 0. Assuming a 14-period RSI, the 0 RSI value means that prices move lower for all 14 periods. So in other words, if you had the 14 1-hour candles and all of them were losses, your RS or your average gain would be what? 0. There's no candle closed higher than it opened. And a 0 RSI value means that prices move lower for all 14 periods. There were no gains to measure. RSI is 100 when the average loss equals 0. Or the opposite, if the average gain was equal to 0, it's at 0. So anything in between, very rarely you're going to get zeros. So that's why you look between the 70 and the 75. The default look-back period for RSI is 14, but it can be lower to increase sensitivity or raised to decrease sensitivity. Okay, now remember, when we changed the barriers from from 80 to 75 and 30 to 20, that didn't change any of the calculations. All it did was change the purple area of the barrier. Now you can change the sensitivity. When we calculated RSI, let's go back to my chart here. The calculation for this RSI was 14 period length used based on the close. So we could, if we drop this to 10, what it did is then it changed the mathematical formula. We're still using the 75-25 barrier, but what happened was it increased the sensitivity and we got more higher bursts above the barrier and below the barrier. Okay. But again, this is a personal selection based on your study of an asset. Now, you'll go on the internet and there's a ton of gurus out there with the whole thing that use an 80-20 and use a 6.5 day RSI. And that's it. You're just trying to talk you silly. Everybody's got their own point of view. And the fact is, it might have worked for this one asset in those couple trades a couple times, and he's trying to impress you with the system. But the fact is, a 14-day standard RSI has been around for a long time, and we know it works. Anything beyond that, you have to check and back check the assets, change the market. Markets change from time to time also. So the look back parameter also depends on the asset's volatility. For example, a 14-day RSI for internet retailer Amazon is more likely to become overbought and oversold than a 14-day RSI for like Duke Energy, who hardly moves at all. So an RSI for Bitcoin would show a lot more volatility, and you might have to extend that look back period, change its barriers, because it's an asset that has huge movements and lots of volatility. So raising overbought to 80 or lowering the oversold to 20 reduces the number of overbought and oversold readings. Short-term traders sometimes use a 2-period RSI to look for overbought and oversold below 80 and 20. Since RSI measures the relative strength of the underlying market, it's a technical tool that can be applied to nearly any market. However, it is commonly applied to more liquid and larger markets like Forex, stocks, and commodities. Now, keep in mind, in a downtrend, RSI can remain oversold. Use the center line to determine the market direction. In other words, when RSI is moving up and breaks that 50 line, okay, it tells you something. When it's falling down and breaks that 50 line, it's also telling you, it's helping you determine market direction. So when selecting the indicator of your chart, you'll be prompted to change the parameters of the RSI. It would be better for new traders to keep the default setting of 14 as your period, and this 14-day period to have the last 14 trading days for the last 14, 15 minutes, whichever you're looking at. Okay. When these trend reversals happen, we want to get into the market and ride the trend as long as possible, preferably until the next trend. So RSI will help us predict when the next trend is starting, and less so when the last trend is ending. Now, there's 3 ways we can use RSI: overbought and oversold levels, RSI ranges, and divergence. And you'll hear it often when you're looking at CNN or the Wall Street Journal, or you're reading it somewhere on the internet. You'll see that XYZ stock is said to be oversold. Well, that's because it's relating to the indicator. Unfortunately, it is not as easy as buying when the indicator moves below 30 and selling when the indicator moves above 70. Allow the price to cross below 30 and then rally back above it before buying. Let the price cross above 70 and then let it back below before selling. Okay. That's the general way that RSI works. Now we're going to talk about stochastics. We're going to talk about if you'd want to use them together. Now there's also an indicator that's called Stochastics RSI that combines the two. Okay, hold on, let me pop it up on the chart for you. I think I have an example also. There we go. So right here on this chart, for the Euro New Zealand dollar, we're looking at an RSI on the top, which is a 14 period based on the close. Underneath of it is stochastics. Like I said, I don't use either one of these. I'm a price action trader, as you can see from all on the charts above. Okay. And then down below, underneath of that, we have a indicator that combines stochastics and RSI. It's called Stochastics RSI. And basically, it does nothing but combine the three indicators. So we have the RSI length of 14, we have the stochastics length of 14, and we'll talk about it. Stochastic uses a K and a D. And then it combines it all together into this one indicator. And if you notice, there is some slight differences, and you can visually see the differences. Again, personally, if I use anything, I use MACD that's down below here. So I would take all three of these off the chart and use MACD, because I don't find anything in these three oscillators that help me make any trading decisions. But that's me personally. That's not for you. You decide what works best for you. So before we combine them together to use RSI and stochastics, we have to understand the slight differences. Now, stochastic is a momentum indicator. And the best way to explain it is, if you ever had an apple fall on your head while sitting under a tree? No, me neither. But Sir Isaac Newton did with the small thud, and he came up with the universal law of gravitation. What goes up must come down. It's not only true of apples, but it's also true of the financial markets. And there are several chart oscillators that try to identify share pricing turning points that investors can exploit. One of the most regularly followed trend indicators is stochastics. It measures the distance between a stock's closing price and the range of highs and lows over a specified period. So, does that sound much of a difference of what we talked about for RSI? If we were to take a 14-day look back or 14-period look back for stochastics, we would then calculate the range of highs and the range of lows. But this is the biggest difference that it is, because it uses highs and lows instead of gains and losses, because RSI uses gains and losses. And you could have a stock that was very volatile and have lots of highs and lows, but it didn't have a big movement in gains and losses. So the stock closes nearer the high of the range, the Stochastics Oscillator rises, and as the stock closes nearer the low of the range, it falls. Proponents tend to like the Stochastics Oscillator because it's an easy to remember defined range of 0 to 100. No matter what you do with stochastics, it will always come out between 0 and 100. And its ability to signal divergences in a share movement. According to developer George Lane, the Stochastics Oscillator moves into overbought and oversold areas above 80 and below 20. So personally, if I were to use one of the two, I would be stochastics, because I believe that we get more out of seeing average, taking our figures from highs and lows, than we do from the difference between opens and closes. Now, George Lane used my rocket, I actually got it from him, example. If you visualize a rocket going up in the air, before it can turn down, it must slow down. And that's what stochastics shows us, is where it's slowing down. It can stay going up, but it's just slowing in its momentum. So as with most oscillators, you'll first need to know the directional trend of an asset, whether it's rising or falling. And you'll need to determine that trend over a set time, for example, a 20-period moving average. It may help to look at your asset in a table to see a stock's direction, position, and relative index, like a chart. So stochastics is different because it uses two lines. If you notice when we saw it on the chart, it had the red and the blue line. These are called the D and the K line. So the fast moving line is shown as a %K in black, and the slow moving line is a %D. A slow moving stochastics smooths the %K line using a default of 3-period simple moving average. The %D line then reflects a moving average of the %K. So what we do is we get the %K, then average it over 3-period, and that becomes the %D. The %K crossed above the D, giving us an indicator of support, as the price portion moved below the 20-period moving average. Conversely, potential exit point presents itself when the stock moves below. So whether we're apples or stocks, gravity pulls things back to Earth. Okay, and we should be able to see when they're moving back to Earth. So let's go back to the live chart. Let's get rid of RSI and let's put on here some stochastics for you. Oh, something's up with my computer tonight. Okay, so what we have are two lines down below. So stochastics uses, as the settings, we're going to use to do the K line, we're going to use a 14-period look-back period. Then we're going to use a smoothing period of 1, and we're going to use a %D smoothing period of 3. So the %K line, let's make it a better color. Let's see. Let's make the %K line a dark purple, a bright purple. And let's make the % bright yellow. Maybe you can see that better. Okay, so we have the purple and the yellow lines. The yellow line is a derivative of the purple line. So they are called the K and the D line. So the general theory serving as the foundation for this indicator is that in a market trending upward, prices will close near the high, and in a market tending downward, prices close near the low. So in other words, when you see candles on a chart and it's a nice downtrend, the close of that period is usually towards the bottom of the wick or near the low. Okay. When you see an uptrend, because the bulls are pushing the price up, they might push a high a little bit higher, but it's going to close pretty close near that high. The transactions are created when the %K crosses through the 3-period moving average called the %D. So you consider one a trigger line if you like. Stochastics measures the momentum of price. So before we get into using stochastics, we should get a clear moving of what momentum is. Investopedia defines momentum as the rate of acceleration of a price of a security. So it's not just the momentum, it's a combination of things pushing it up there, but it's how fast and far it is traveling at a certain time, or its acceleration. So considering the most traditional settings for the oscillator, 20 is typically considered the overbought threshold and 80 is the overbought threshold. Now the difference is stochastics indicators calculated by using this formula. The %K line is equal to 100 times the close minus losses, the lows over the 14-day period, divided by the highs over the 14 days minus the lows. So C is the most recent close. L14 is the low of the 14 previous trading sessions. H14 is the highest price traded during the 14 trading sessions. And the percent K is the current market rate for the pair. And then we take that and we take a 3-period moving average, and that gives us the percent D line. Transaction signals are created when the percent K crosses through the 3-day moving average that is called the K20. So we get the overbought and oversold zones like we do from RSI, but we also get the signal line that gives us a idea that we should be trading the asset at the crossover. So Stochastics RSI now combine it together. The Stochastics RSI considers the relative strength index and applies the Stochastics Oscillator formula to it, deriving market trends that are more sensitive than RSI alone. It is a technical indicator built through the combination of Stochastics Oscillator formula and the relative strength formula, and it ranges from 0 to 100. The Stochastics RSI considers a relative strength index and applies the Stochastics formula to it, deriving market trends that are more sensitive than RSI alone. It's a technical indicator built through the combination of the two. Stochastics RSI allows traders to identify whether an asset is in the overbought or oversold territories. Of course, you're excited to know how it works, but let's first understand the fundamentals. Since Stochastics RSI is derived from RSI itself, it makes absolute sense to understand the concept. Basically, the RSI is a technical indicator that tracks an asset's momentum, identifying whether a cryptocurrency or an asset is overbought or oversold. RSI alone gives limited buy and sell signals, missing critical entry points for intraday trading. On the contrary, Stochastics RSI is more sensitive to market movements, allowing traders to find multiple entry and exit points. However, it's still critical to combine Stochastics and RSI with other indicators to avoid early or late sell or buy calls. Stochastics RSI considers the RSI's index movement within a given period without emphasizing the current price level. The most popular calculation is based on 14-period look back. The result is a figure between 0 and 1, swinging on the center line of 0.5. It is essential to note that some Stochastics RSI calculators multiply the output by 100, providing readings between 0 and 100. So that is how we would combine and use it. How you make your trading decisions is completely up to you. Overall, if I were to take any of them, I would use Stochastics. Using the two, and even though they're both very popular, are using two indicators that are very similar that would kind of mute out each other's signals. You're better off using a diverse signals that are diverse, indicators that give you diverse market looks, like combining Stochastics with MACD, as opposed to combining two that give you overbought and oversold ranges. But this will give you something to think about. And there's lots of traders that swear by the Stochastics RSI combination. It's a different way of looking at two other indicators. But it's up to you to evaluate and figure out what works best with your trading system, your strategy, and the asset you trade. So thank you very much for joining us tonight, and have a great trading week. Bye now.